Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Today we're going to pick up where we left off with the 20 pip challenge, except we're going to show a profitable version. A version that doesn't use stop losses, but rather it uses accumulation. So let's get straight into the chart and talk about what we are looking at. I have a mock-up here that demonstrates what we're used to seeing. And that is the moving averages we've been working with, the 200 period, the 20 period, and the 50 period, with the crossovers taking place appropriate to our rules. But instead of a stop loss, we're using an accumulation approach, or dollar cost averaging. Dollar cost averaging is a unique philosophy because it doesn't take losses. Every time you would normally hit the stop loss, a dollar cost averaging methodology makes another purchase. So let's see how that actually looks. We have the first buy signal here. It made the purchase exactly as the crossovers have indicated. But as you can see, the market went against what we were doing. So normally where a stop loss would be, it made another purchase. So it added to the point of its profitability. So even though the market went against it, it didn't cause a loss, but rather added more to what you're holding. So if your first purchase was 10 units, your second purchase will give you 20 units. And as you can see, the market still goes against what we are doing. But then the market goes in our direction. And we get our 20 pips. And we sell it for a profit. Now this looks nice, sweet, and wonderful. But it has its own inherent risks. And that is the asset itself could completely go against you. This is very typical with weak assets or assets that have poor liquidity and poor volume. But for strong markets and worst case scenario planning, then you don't have to worry about it as much. This is actually one of the best ways to make a profit, and one of the ways to help control your risks in the market. So for example, for this particular case, instead of trading 1% of your account, you might trade 0.1%, thus mitigating your risk even more. But because of the way this process works, it accumulates profits over time. And those accumulations will pay off. But as you can see here, we get into the market for the first purchase, but then we have a second purchase, a third purchase, a fourth purchase, fifth, sixth, seventh, eighth, nine purchases so far. 10, 11 purchases before the market finally starts moving in our direction, painfully slowly. But the cause of that gave us nonetheless a profit, and that profit took 11 purchases. Now because of this particular strategy, it doesn't accumulate a lot, but 11 purchases would be 11% of your budget if you used 1% per purchase. That's not bad. But if you're using aggregation, you're going to be trading more than one asset at the same time. So using 0.1% of your budget means you have more resources available for more aggregated pairs, but less risk. So it's a trade-off between one or the other. You're guaranteed, reasonably speaking, to get a profit at some point. But the risks behind that are a different mindset. I personally prefer accumulation as my own personal strategy, as I find simply waiting for a market like the one we have here is going to produce results in the long term. It's a process of figuring out what works best for you and your own trading risks. Understanding both of them are critical, but picking one for you is what will make you successful in the long term. For me, accumulation represents a better possibility because I can mitigate losses as much as possible. So let's actually get into the code and take a look at where the changes need to take place between the stop loss version and the accumulation version for the 20 pip challenge. Now that we are in the VPS with the source code loaded, what you're going to actually see is that not very much has actually changed. In fact, the differences between the 20 pip version previously and this version are really very minimal. So let's start going through and looking at the process. The analysis class is actually identical. Nothing changed in this at all. So we're going to go through and skip it. None of this has changed. So far, none of this has changed either. Now we start getting into the main body of the code, and let's bring this back up to the top. If you remember the code from the last version, you will see that the only thing changed here is instead of a stop loss, we have a deviation pips variable. So instead of 15 pips stop loss, the next purchase takes place at 15 pips, but only if the three moving averages line up properly. And that becomes quite interesting the way the program works, because it really doesn't take on that much accumulation. It's actually very minimal. So this is the only part that changes in this section. Now let's get down to the next sections. You will find all of this is pretty much the same. All of this is pretty much the same. And even the selling section is identical. Because the differences between a single position 20 pip, like what we did, and this one, from selling it, aren't that different. Instead of one position, we are simply looking at the average of all positions. So when the take profit is above the average of all positions, as we see up here, where is it? We actually end up with a case that we can easily figure out. Okay, here we have the T price and the take profit. And here we load the ticker, the balance. Okay, here we are. Get average. Right here. Just like the previous version, we go get the average of what we're holding. But what we're holding isn't just a single position. It could be 3 positions. It could be 12 positions. It could be 10 positions. It doesn't matter. The average is the same. So when we do our comparisons, whatever this number is what our comparisons go against for the take profit. And every purchase adds to and manipulates the average of what we're holding. So right here, this whole section, even though we are using a whole different process, the irony of it is this section isn't different. It's identical because of the way we set everything up, which makes it really nice. It makes it easy. Now, we don't have a stop loss, so the entire stop loss section has been removed completely. And that would have been right in this area as well. But now we get down to the purchase. This really is the biggest change of the program, with the exception of the removal of the stop loss code. Okay, we do our test, we check our ticker, and then we actually run through the analysis that we demonstrated in a 20 pip challenge, looking at the 3 different moving averages and deciding and tracking where the market is going. Okay, here is for the short side of it. Now we calculate our lot size, convenience variable, because we're using the first in, first out regulations. So we need to be able to figure out what is the highest number between the number 1, no position whatsoever, whatever our current lot size is from what we're holding. Now we have to look at the actual amount we're holding to determine what our next position size should be, or the percentage of the balance. So if we're holding nothing at all, then we need to take whatever that percentage is. In this case, it could be 0.1% or 1% or 2% or whatever is appropriate to your personal trading. If you take a percentage of balance, then you want to factor in your current margin rate for this asset. This is not an overly complicated line, but it does have a significant role within how the position sizes are picked and chosen for your next position when you accumulate, or for your first position based upon your settings. Now we get down into the actual purchase part. So right here, if it's a long and buy long, so if the mathematics say we should buy a long position and the direction we want to trade in is the long position, then we place the trade. Now, since buy long has automatically worked out whether or not the moving average is taking place, then we are good to go. Short, sweet, and simple. And now buy short is the same thing. We take into account whether or not we are trading in a short direction. But because Oanda wants lot sizes in a negative value for shorting, we just multiply the lot size by -1. A simple, quick, dirty little trick to flip it around. So as you can see, the buying side isn't that complicated. It's actually pretty simple. And now we look at the rest of the program, exactly as it was in the previous version. So we really have very little change that was made in this program, and it now does not take losses. In fact, it will make very good profits on its own over time. And that is actually something to really pay attention to. So, practice with this, experiment, ask questions, leave comments. This code can bring you a lot of profitability if you know what you're doing and if you take the time to study the market. It's really a simple process, but the beauty of such code is that it can run 24/7, where you simply can't. It does an exceptional job of mitigating risk, and that really does the biggest point of what automated trading does. So we've taken the steps of building on our last program, and now we have a genuinely profitable version that will make money over time. That is the most important aspect of trading, making money over time through patience, science, and mathematics. If you like this video, please give it a thumbs up. Hit that like button. If you want to see more videos like this, please ring the notification bell. Ask questions if you have any. Leave a comment. Share your thoughts. What do you think of accumulation versus a stop loss technique? Is this something you think would help you in your trading? Be sure to join the Discord support server and be able to ask me questions just about any time of day or night. And I am usually pretty responsive in getting information out very quickly. Thank you for watching, and until next time.